Well, hello and welcome to our final WebEx session of the semester. I'm your host, Dr. B. This is Accounting 202, Managerial Accounting. We have reached the end of our course. This is the final full week of our course. In this week, we'll be discussing capital investment analysis, and we'll also be discussing lean manufacturing concepts in chapters 25 and 26 respectively. Since we are in the final week of the course, what this means is that we have some work to do. We have our chapter 25 discussion and our chapter 26 quiz. Both of these items are due by Sunday, by this coming Sunday at 11:59 p.m. That also means if you have any other past due work, that also must be completed by this Sunday at 11:59 p.m. Unfortunately, there cannot be any exceptions made to this rule because your final exam is currently scheduled for December 15th, which is Tuesday, a week from today. You must take the final exam by December 15th. The good news is the final exam is currently open and is ready for you to take. I recommend that you start the exam early, save your work, close your work, don't submit your work, but save and close. It's worth 20% of your total grade, or 20 points, however you want to look at it. What does that mean? The final exam covers the last 8 chapters of the course, okay? The final exam is 20 questions in length. The final exam is worth 20% of your grade. I strongly recommend that you start early and save frequently, okay? It's open book, open note. It's very, very important that you understand the homework assignments and the quizzes over the past 8 chapters, because you will see very similar questions on the final exam. The final exam is a mix of true, false, multiple choice, matching, just like your midterm was. Follows the same type of sequence. The questions are randomized. So please, please, please start it early, take your time. But remember, you must submit it by December 15th. The last day of this class is technically this Sunday. The final exam is scheduled for December 15th. All coursework must be submitted by this Sunday. Final exam must be taken by December 15th. I will be probably emailing you almost every day from now until the last day of the course to keep reminding you of what needs to be done. So there's that. This is the last session. All assignments must be submitted on December 13th. All remaining coursework December 13th. The final exam must be taken December 15th. I will have your final grades posted by next Friday to the registrar's office. It'll probably happen before then. So, okay, that's where we are. Wonderful. We're almost done. Okay, let's jump into it. Chapter 25. Capital investment analysis. That's real cute. Really what this means is we're going to be talking about a financial concept in finance. Yes, it's an accounting course, but as you know, there are finance components related to accounting. This chapter talks about what we call net present value or present value. All of these terms are called time value of money concepts. Time value of money concepts. The time value of money discusses the concept that a dollar today is worth more than a dollar tomorrow. And the reason for that is that a dollar today has higher earning potential than a dollar tomorrow does. We'll talk more about this concept. So companies typically look at their investment decisions from a long-term perspective. Capital investments, also known as capital budgeting, is a process where management takes a look at plans, evaluates, and controls investment in their fixed assets. As you know, fixed assets are property, plant, and equipment. Capital investments decision making can be grouped into two different methods. Methods that do not use time value of money, also known as present values, and methods that do use time value of money, which are present values. Methods that do not use present values, they will calculate the average rate of return method and the cash payback method, both concepts which we talked about in the previous week. But we'll dive a little bit deeper. Methods that do use time value of money or present values calculate the present value and the internal rate of return. For those of you who are familiar with Excel, Microsoft Excel, you can actually calculate all of these using Excel. The two methods consider time value of money concepts. Time value of money concept recognizes that $1 today is worth more than $1 tomorrow because $1 today can earn interest. Example, if I put $1 into my bank or $100 into my bank, and my bank tells me that I can earn 3% interest, compounded annually. By the end of that first year, I will have $103 in my bank account. The $3 represents the 3% interest. Okay? That is represented in the time value of money. Time value of money, the principal, $100. The interest rate, 3%, or 0.03. The time, 1 year. Those factors are the time value of money. The present value is $100. The interest rate, 3%. N, which is the number of periods, 1 year. Also be expressed monthly, as in 12 months. You can figure out the payment function and the future value. The future value would be $103. The methods for present values are very useful when it comes to evaluating a capital investment proposal. A proposal, as you know, is an idea or a suggestion that we will make a specific investment. Okay? And that investment has a useful life. We talked about useful life when we talked about things like equipment, buildings, fixed assets. Fixed assets have useful life. Property, plant, equipment has useful life. Earlier in the semester, I gave the example of a dump truck. I purchased a dump truck for $25,000. The useful life of that dump truck is 5 years, which means it'll depreciate $5,000 per year for 5 years until it reaches a value of 0. So using present value, we actually will look at a few different proposals. One would be, I buy this particular dump truck. The other one is, I buy this other type of dump truck. The third would be, I buy a different piece of equipment. Okay? And so I'll look at this project that I have. I'll look at these three proposals in relative terms of useful life, and I'll look at it over time. in terms of cash flow. So, for example, let's say I own a construction business. I'm going to put up a building. It will take me 3 years to put this building up. I'm going to buy a dump truck for this project at $25,000. Is it worth it? How do I know that the purchase is worth it, the $25,000? Well, I will look at the cash flows for that 3 years it takes to put the building up. Cash flows, as you know, we talked about this last week. Cash flows is cash coming in and cash going out of the business each year. That's cash inflow minus cash outflow equals net cash flow. From that, we can determine if a project is worth it or not, is worth an investment or not. If the net cash flows are greater than the investment, then we do the project. It makes sense because will actually benefit from that project, right? So this is what time value of money tells us. Because these methods are use present values and they're easy to use, we often use these to determine which investment is the best one to go with, which proposal is the best one. So we mentioned earlier that there are two methods, one that does not use present value and one that does use present value. What we're going to do is we're going to look at each component that does not and does use present values. The first one is the average rate of return. This is also known as the rate of return or accounting rate of return. It is the percentage that tells me if what I would get back from my investment. Okay. Average rate of return, we calculate that by first taking the estimated average annual income and divided by the average investment. Well, how do we get the estimated average annual income? The estimated average annual income comes from the average annual income. If you look at a projection over a number of years, let's say we're going to purchase a building, okay? Or we're going to, we're in the construction business. We're going to build a building. We expect that our average annual income is going to be $1 million per year. Annual income. Some years it might be 1.2, 1.4, 900,000, 800,000. We average those years together, we get $1 million. Okay, that's how you get average annual income. It's an estimate. Then we divide that by the average investment. To get average investment, we actually take the straight line depreciation to get average investment. So to get average investment, we take the initial cost plus the residual value and divide by 2. That gives us the average investment. Initial cost of the dump truck, $25,000. Residual value, 0. Or it could whatever it's worth at the end of the project, right? Divided by 2. That gives me my average investment. Let's look at it from another example, a cost of a new machine. The new machine cost $500,000. Residual value is 0. The estimated total income from the machine is going to be $200,000. The expected useful life is 4 years. To get the average investment, we take the initial cost, $500,000, plus residual value of 0, divide by 2 to get $250,000. To figure out the average rate of return, we take the estimated average annual income divided by the average investment. Now, how do we get $50,000 from the estimated average annual income? Well, it said that our estimated total income from the machine is $200,000. If the estimated useful life is 4 years, we simply take 200,000 divided by 4. 200,000 divided by 4 gets us to 50,000. Estimated average annual income. Estimated average annual income. 50,000 divided by our average investment, 250,000 that we got from above, equals 20%. Our average rate of return is 20%. So that means if a project is valued at 25% rate of return, my minimum rate of return or average rate of return is 20%, then I will accept that project because it's above my average rate of return. We'll talk more about that. The average rate of return, 20%, should be compared to the minimum rate of return required by management. We call this a minimum rate of return. Minimum rate of return. Minimum rate of return basically tells me what should be the lowest I would accept when I do a project. If my lowest is 20% and my average is 20%, I'll probably do the project because my minimum is 20%. If the rate of return for a project is 25% and my minimum rate of return is 20%, I'll accept that project because it's above my minimum rate. If a project comes in at 18% and my minimum rate of return is 20%, I will not do the project because it's below my minimum. So in other words, I will look at the rate of return, my minimum rate of return, to determine if I should purchase that machine or not. If the machine will yield me higher than my minimum rate of return, then I will purchase the machine. If it does not, then I'll look at other alternatives. Average rate of return is very useful because it's easy to compute. It includes the entire amount of income earned over the life of the proposal. And of course, it emphasizes accounting income, which is very useful for investors and creditors, of course.
Professor, I have a question.
Please, Fritza.
So when you're buying this equipment for your business, this is how you're supposed to look at set purchases. So for example, a laptop will give us a lot of return because it's so multifaceted, and unless something falls on it or there's like a hacker or something, that's not like something we have to worry much about versus actually the functionality of the laptop, correct?
Yeah, that's one way of looking at it. So, but
Okay.
the way you want to look at something like that, let's say you're purchasing a supercomputer, okay, and this computer is $100,000. But with that computer, you are running a business, and your business is expected to earn $200,000 per year using that computer over the next 4 years. So you take that $200,000 as your average income, divide that by the $100,000 that it costs, you'll be looking at a 20% return or 2% return. The idea here is that the asset that you're purchasing, whether that be a laptop or a supercomputer or a building or whatever, right? Any fixed asset. If that laptop is helping you to generate revenue, generate income, and it's expected to last for X number of years, we can determine the rate of return for that laptop based off of your expected income per year and the cost of that laptop and the life expectancy of that laptop.
Oh, yeah, we did the assignment not too long ago in regards to something similar like
That's
this.
right. That's right.
Yeah,
Exactly. Yep.
right.
It follows
So
the same.
this one, I'm sorry, go ahead.
No, I was just saying it follows the same principles, same concept.
Okay. So basically, if my best friend and I were trying to find like purchase a minivan to go pick up those seniors, we're gonna have to look at the quality of the brand, all the quality, the expense, and the return, and to we have to use that into consideration when purchasing that our first vehicle.
Absolutely. And what you want to do, Fritza, when you purchase a vehicle that is for a business, you want to look at this component, okay? The initial cost of the vehicle, let's say it's $20,000, okay? Its residual value, we'll say, is zero. At the end of the business, it's worth nothing, right? Divide by two to get, for averaging, equals $10,000, right? Because you purchased for 20, and we're dividing it by two, so it's $10,000 average investment. The business that you're running, we're going to say that your first few years you'll average about $50,000 of income. Okay, $50,000 divided by the $10,000 equals, whatever that is. So I'm going to quickly run some math. So 50,000 divided by 10,000 equals 50%, right? So
50%.
right. So 50% average rate of return, which is super high, by the way. Then yes, in that case, it would be worth to purchase a van for $20,000. How do we know that? If your average rate of return is 50% and your minimum rate of return, we'll say, is 10%, then yes, it's a very wise investment for you to purchase that minivan to use it for your business, as long as your annualized income is relatively stable.
That makes a lot of sense. Thank you, Professor.
Yeah, absolutely. Yep, absolutely. And that'll help you to make that purchasing decision, no doubt. Some of the disadvantages with this concept is it doesn't directly consider expected cash flows from the proposal. So, for example, we talked about cash flows in the previous chapters. Cash inflow minus cash outflow equals net cash flow. The rate of return does not take into consideration those cash flows. It only takes into consideration average annual income. If it were to take into consideration the expected cash flows, it will be more precise. It'll be more exact, right? But this type of formula does not take that into consideration. And I'll show you one that does, especially when we get into present values. And it also does not take into consideration timing of expected cash flows. In other words, 1 year might be lower cash flow than another year. This formula does not take that into consideration. It only looks at the average across the number of years. So that's one of the disadvantages of utilizing the expected rate of return. Let's look at your example again, Fritza. We'll look at it from a cash payback period method. The expected period of time between the date of the investment and the recovery in cash, we call that the cash payback period. Think of it this way. You purchased a minivan for $20,000. How long is it going to take me to recover that $20,000? That's the cash payback period. When an annual net cash inflows are equal, the cash payback period is computed by taking your initial cost divided by annual net cash inflow. this assumption tells us that our business is expected to make the same amount of cash inflow for each year. It's not that entirely realistic because we know that in business cash inflows go up and down depending on the year, but the initial investment does not change. So for simplicity, we estimate the annual net cash flow will be the same for each year. So the initial cost is $20,000. My annual net cash inflow is $50,000 per year. Then we expect it to be 50%. But let's look. Let's take a look at this example. Let's assume that we're purchasing a machine for $200,000. Our cash revenue for the machine per year is $50,000. The expenses of that machine per year, including depreciation, is $30,000, and depreciation per year is $20,000. To simplify, we look at the following: the machine revenue is $50,000. It costs us $10,000 per year to run that machine, giving us a net cash inflow of $40,000 per year. Net cash flow $40,000 per year. Minus other expenses such as depreciation, $30,000 minus depreciation expense $20,000 gives us a cash expense of the machine of $10,000. So the machine originally cost us $200,000. Our annual net cash inflow is $40,000. That means it'll take us 5 years to recover that original $200,000. So, Fritz, if you use your car example, $20,000 initial cost divided by the net cash flow for that car,
which is 50,000 a year.
50,000 a year, but
that's what we use the example, right?
Right, but if it's before, let's say that 50,000 for the year is before any expenses. Let's say you spend $10,000 a year in fuel and gas. Okay, that brings us to 40,000 per year of cash inflow. So the initial cost, so the cost of or the expected revenue minus the cost of fuel per year equals 40,000.
Oh, I see. So if you go back to the other slide, then there I will not put 50,000. I will put 40,000
That's
because
right.
Minus the 10,000 in expense and fuel.
That's right. So it would be the cost 20,000 divided by 40,000 would give you, in that case, so it would be 2 years. Well, actually, it'd be like 2 months, right? But yeah. So the point that we're trying to get here is that your cash payback period is the number of years it takes you to recover that initial investment. In this example, the machine costs us $200,000. Our net annual revenue for that machine is $40,000. Why $40,000? Initial cost, the initial revenue is $50,000. We have $10,000 a year in expenses, so that's $40,000. So initial revenue minus the cost per year equals the annual net cash inflow. So the initial cost of the machine divided by the net cash inflow, in this case 40,000, says it'll take 5 years for us to recover that initial 200,000. In the preceding year, the annual net cash inflow is equal to 40,000 per year. When the annual net cash inflow are not equal, the payback period is determined by adding the annual net cash inflows until the amount equals the initial cost. In other words, this first example that we looked at, we assume that our net cash flow each year is the same. That's an assumption. In business, that's not ever true. It's usually going to change. So let's look at it from an example where the annual cash inflows change from year to year. In year one, we had a net cash flow of $60,000. Year two, we had a net cash flow of $80,000. Year three, we had a net cash flow of $105,000. Year four, we had a net cash flow of $155,000. Year five, $100,000. Year six, $90,000. You can see that each year it's not the same. It's different for all 6 years. Let's assume that we have a machine that we want to purchase. The initial cost of that machine is $400,000. At what point will I reach my payback period? Well, what we do to figure that out is we add up all of our net cash flows until I reach the point of my initial cost of the investment, $400,000. So in this case, $400,000 is reached at year four. So at the end of year four, I will be able to hit my cash payback period. So at the end of year four, I would recoup my initial investment, and anything above that is profit. So in this case, end of year four, I reach my initial cost of $400,000. So that's like saying the cash payback period is 4 years. A short cash payback period is desirable, obviously. I want to recover my initial investment as quickly as possible. We don't want to spread that over time. Why? Because a shorter cash payback period is desirable for quickly repaying any debt that we use to purchase that equipment, and we can also benefit economically through profit. So, Fritza, if it takes you, let's say your cost of a van is $20,000, we expect that your company will generate $50,000 in annual revenue from that van, from the use of that van. It costs you $10,000 a year in operating costs for the van. So that gives you a net cash flow of $40,000. The initial cost is $20,000 divided by the net cash flow of $40,000. That means you will reach a cash payback period in 6 months. It will take you 6 months to generate the initial cost of that van. So within 6 months, that's a short payback period. You'll be able to pay back the loan for the van, and you're good to go. So that's kind of another way of determining if that investment is worth it or not. How quickly can I pay it back? Also known as the cash payback period. It has its advantages. Very simple, easy to understand, easy to analyze using cash flows. The problem with cash payback period is that it ignores cash flows after the payback period. It does not use present value concepts in its calculation. But it's useful. It's very easy to understand. I personally like it. That's how I determine, like even buying a house, right? How quickly can I pay that house off? Well, you look at your net income. You look at the initial cost of the house. you can figure out exactly how many years it's going to take you to pay back that home loan, right? But that you can use that method. It's very quick, very easy, but it doesn't take into consideration present value. Present value takes into consideration the interest rate, um, future value of the house, things like that. So let's look at that from that perspective. Investments into fixed assets like a house or a building may be used in purchasing a series of net cash flows over a period of time. Timing of when those net cash flows are received is very important for determining a proposed investment. Present value methods using the amount and timing of net cash flows is very important. Okay, so let's look at this example. Let's assume that you have $1 to invest today. You're going to invest that dollar for a period of 3 years. Okay, so you put that dollar in the bank for 3 years. Bank says, hey, we'll give you an interest rate of 12%. I don't know what bank does that, but if you let me know. Okay, so you invest $1 today. The period of investment is 3 years. Interest rate is 12%. Here's how the math works. We assume that dollar each year will yield you 12 cents. Okay? So at the end of that first year, you'll have $1.12 in the bank, right? Now in the second year, you start the second year with $1.12 at a rate of 12%. So you take your $1.12 times 12%, gets you to 0.134. 0.134 is the amount of interest that you earned on that $1.12 in that second year, which means that at the end of the second year, you'll have $1.25.4. Now, you leave that $1.25.4 in the bank. At the end of the third year, you'll have $1.40.4. We call this compounding interest. Compounding interest. It's where interest earns interest over time. Okay? So I put $1 in the bank. At the end of the first year, it was $1.12. I left that $1.12 in the bank. At the end of the second year, it was $1.25. I left that $1.25 in the bank. At the end of that third year, it was $1.40. We call this compounding interest. It's where interest earns interest, right? And it compounds over time. Here's a nice graphical representation of that example we just explored. $1 times 1.12, also known as 12%, gets us to $1.12. $1.12 times 1.12, 12% interest, gets us to 1.254. 1.254 times 12%, 1.12, equals 1.404 at the end of the third year. This is compounding interest. Another example. On January 1st, 2016, present value of $1.40.4 is received on December 18th. Partial present value of $1 inbox indicates that $1 received over 3 years, compounding at the rate of 12%, is 71 cents. So, in other words, over 3 years, I put that $1 in, beginning of year 1, over 3 years, at a rate of 12%, I earned a total of 71.2 cents for that $1. Does it make sense? Any questions? Hope it's relatively straightforward. Just practice it. Promise the more you practice, the better you get. Now, the difference between future value and present value. Future value tells me the value of $1 in the future. Hence the name future value. Present value tells me how much was the initial investment at the present time. Hence the name present value. So at the end of year 3, if I had $1.40.4 in the bank, I can figure out how much the initial investment was at the beginning of year 1 by working backward to figure out present value. I put the future value amount in times the partial present value, which comes from the interest rate times the number of years, times the future value times the interest rate times number of years equals present value. It's another way of looking at it. Okay, now let's calculate and talk about the present value of an annuity. We talked about annuities before. An annuity, as you know, is a series of equal payments at fixed intervals. An example would be you pay monthly rent. That's an annuity payment. You receive a monthly salary. That's an annuity. You receive interest on a bond every year. That's an annuity. Just know that an annuity is you're either receiving or paying, but it is a payment of equal cash flow at fixed intervals. So once a month you receive your Social Security check. That Social Security check is an annuity. Once a month you pay your rent or your mortgage. That payment is an annuity, right? It's the same amount every single month, same time every single month, fixed intervals, right? Present value of an annuity is the amount of cash needed today to yield a series of equal net cash flows at fixed time intervals in the future. Ooh, that's a mouthful. Here's how you want to think about this. How much money do I need to have, or how much money do I need to invest in my 401k to receive $2,000 a month when I'm ready to retire? That's the type of calculation that you can use in your daily life. So it's like, okay, well, I want to retire at 65. How much money do I need to have before age 65 in my 401k to receive $2,000 a month in retirement? You can calculate the present value of an annuity. That's the present value of an annuity. So let's look at it in very simple terms. Okay. Present value of a $100 annuity for 5 years at 12% can be determined by calculating the present value factors, just like we did earlier in this presentation here. Present value. Each $100 net cash flow could be multiplied by the present value of $1 at 12%, the factor appropriate to determine the present value of $360.50. So, if I wanted to receive 5 equal annuities of $100 in the future, and the interest rate is 12%, I would need to have $360.50 today in order to receive $500 over a period of 5 years in the future. That's what this tells us. here's how it looks graphically. Here's how it probably makes more sense. So that first $100 that I would receive, the interest on that is 0.93 times that $100, which means I need to have $89.30 in the bank for that first year in order to generate $100 by the end of the year, right? 89.3. So, or you just take your $100 that you want to have in the future, take that amount, you multiply that by 0.893. Why 0.893? Comes from this table right here. 0.893, year one. 12%. 12% is the interest rate I was told I would have for year one. It's 0.893. Year two, it's 0.797. Year three, it's 0.712. So looking back at our, oh, I'm sorry, I went a little too far. 0.893, 797, 712, 636, 597. 5 years, right? We can see that each amount represented here on the left is how much money I would have to have in the deposit in the bank for that respective year in order to generate $100 for that following year based off the interest rate. Think of it like working backward. Think of it like working backward. Take the amount you want to have in the future, multiply it by the present value rate to tell you how much you need to have now in order to get that amount in the future. Does it make sense? Any questions so far? We're okay? All right. Oh, sorry, mouse is acting up. So using present value of an annuity table, such as one that we're going to see on the next slide, is a very similar approach. 0.893, 1.69, 2.40, 3.037, 3.605. What this is a present value table of an annuity of a dollar using compounding interest. Compounding interest. As you know, compounding interest means we leave the amount in the bank. Don't withdraw it. So remember that dollar that I invested in year one, at 12%, I earned 89 cents. That same dollar, and at the end of year two ended up being $1.69. That same dollar end of year three is $2.40. That same dollar end of year four is $3.03, so forth and so on. So we can see how we invested $1 today at an interest rate of 12%. That will be worth $5.65 at the end of year 10. Call this net present value. We'll talk about net present value. Present value factors in the table are the sum of the present value of that same dollar for the annuity periods. So $3.60 in the annuity table is the sum of the 5 present values of a dollar at 12%. That's why we call it compounding. It's where interest earns interest. Net present value is the method and present value index. This is where we use these in combination. Net present value compares present value to be invested with the present value of the net cash inflows. Ooh, that's a mouthful. In other words, if you add up all of the present values, you get to net present value. This is also called the discounted cash flow method. Using the internal rate of return or interest rate return used the net present value of the analysis compounding company's minimum desired rate of return. Oh, Another mouthful. We call this the hurdle rate. We call this the internal rate of return. Internal rate of return. This is the minimum rate of return that your company requires for an investment to be made. In other words, if I purchase a minivan for $20,000 for my company, transporting senior citizens to various facilities, that van, my company requires a rate of return of 10% in order for me to purchase that van, to make it worth it. That is my minimum rate of return or required rate of return or desired rate of return. So it all means the same thing. If the present value of the cash inflows equal or exceeds the amount to be invested, the proposal is desirable. In other words, I'll do the deal. Here's an example. We purchased a new piece of equipment, $200,000. Expected useful life of that equipment is 5 years. The minimum rate of return, 10%. My expected cash flows are the following. Year 1, $70,000. Year 2, $60,000. Year 3, $50,000. Years 4 and 5, $40,000, $40,000. Total expected cash flow is $260,000 for the 5 years. Right? What we do is we take the present value of a dollar at 10%. Why 10%? Because that's our minimum rate of return. 10% at a dollar. Year 1, it's 90 cents. Year 2, it's 82 cents. Year 3, it's 75 cents. Year 4, it's 68 cents. Year 5, 62 cents. We take that amount from our table, multiply it by our expected net cash flows for each year to get the present value of net cash flow. Net cash flow times the present value rate. We add all of those up for the 5 years to get $202,900 minus the initial investment of $200,000 equals a net present value of $2,900. Here's how it looks graphically. Based off of the net present value of $2,900 indicates the purchase of equipment is expected to recover the initial investment and provide more than the minimum rate of return of 10%. Thus, we would purchase that new piece of equipment. The way I like to say this is if your net present value of net cash flows is a positive amount, if your net present value is a positive amount, it's probably worth doing the project. It's probably worth the investment. Net present value has advantages, considers cash flows, considers time value of money, and you can rank these projects according to their present values. Disadvantages, it's very complex to compute. As we just saw, it does not use present value in consideration, and the cash flows can be reinvested at a minimum desired rate of return, which is not taken into consideration. We're almost done with this chapter, I think. Okay, now let's look at the present value index. When capital investments are limited in the proposal of different investments, we rank the proposals using the present value index. To calculate the present value index, we take the total present value of a net cash flow and divide by the amount to be invested. In our example, we ended up with $202,900 in net cash flow from the purchase of that piece of equipment. The piece of equipment amount was $200,000. The initial cost equals 1.0145. If the value is above 1, then we do the investment. If it's below 1, we do not. So for present value index, above 1, good investment. Below 1, not so much. Okay. The company can use this method, the present value index method, to determine which proposal is best. ABC, present value cash flows, ABC. We can see based off of the present value index that proposal B is the best proposal because it has the highest present value index. It's slightly above proposal A, both of which are above proposal C. Proposal C would be the worst because it's below 1. In fact, I would not do that deal at all. Proposal A and B, yes. Okay, IRR. Oh, another great concept, IRR. We don't go too deep into these time value of money concepts in this course, but they're important to understand because they are concepts that in accounting, in managerial accounting specifically, we use to identify if an investment in fixed assets is worth it or not. Another one of those methods we use is called the internal rate of return. We use present value concepts to compute the internal rate of return based on the expected net cash flows. As you recall, net cash flow, cash inflow minus cash outflow equals net cash flow. This method is sometimes called the time-adjusted rate of return. It's very rarely called that. Starts with a proposal of net cash flows and works backward to get the expected rate of return. Okay, here's an example. We have a new piece of equipment. It costs $33,530. We expect to generate a cash flow of $10,000 per year. The expected useful life of the equipment is 5 years. The minimum desired rate of return is 12%. So what do? Annual cash net flow, $10,000 for 5 years. So 10,000 times 3.605. Why 3.605? Because at $1 at 12% at year 5 is 3.605. 10,000 times 3.605 equals $36,050 minus the initial investment, $33,530 equals $2,520. It's greater than 12%, we do the deal. $36,050 represents the present value in cash inflows based on 12% rate of return, which is greater than the initial investment. Thus, the IRR must be greater than 12%. We actually find out that it's worth 15%. Okay. Let's see. Now, here are the steps, okay? When equal annual net cash flows are expected from a proposal, the IRR can be determined by taking the amount to be invested divided by equal annual net cash flows. So that's step 1. Present value factor. Amount to be invested divided by equal annual net cash flows. Step 2. Using your chart, locate the present value of the annuity by taking the number of years of the expected useful life in the column, and on the line, the horizontal line, we look at the percentage, right, to figure out what is the amount using the table, present value table. Step 3, we identify the interval rate. which is the present value factor. Let's look at this example. Cost of new equipment, $97,360. Yearly expected cash flows, $20,000, 7 years, useful life. My minimum rate of return is 10%. I take my $97,360, which is the additional cost, divided by the net cash flows equals 4.868. I come down 10%, 4.868, coming across 7 years. That's correct. And I would use that in that step number 2. The IRR, its advantages, we consider cash flows from the investment. We use time to value of money, and we can use it to rank proposals. Disadvantages, it's relatively complex to compute. It assumes that cash flows are not equal. And it does not take into consideration anything that can be reinvested at the end. So again, we don't go too deep on those concepts in this course. There might be 1 or 2 questions on the final exam as they relate to IRR. So just know the formula. That will help you. That will certainly help you. Additional factors to consider when making an investment decision: income tax, proposals of unequal lives, lease versus purchase, uncertainty, changes in price levels, qualitative factors. When we look at income tax, what is the tax rate for depreciation purposes? If I'm purchasing a machine for $200,000, its useful life is 5 years. How much can I depreciate over time for tax purposes? That's one reason for making that a decision. Unequal proposal lives. If I have 3 different proposals in front of me, 3 different types of machines, 3 different prices with 3 different useful lives, that will help me to make a decision. So what do? In that situation, we take our proposals side by side, look at our costs, minimum rate of return, useful lives, compute it out over the useful lives for expected cash flows to figure out which investment is better. We do that. We can do that on an Excel spreadsheet to get a gauge of which investment would be the better of the 2. Lease versus purchase. Oh my goodness, a decision we all make, right? Lease the house, buy the house. We look at the cost of the fixed asset. We look at its useful life. We look at the risk of it becoming obsolete, and how much we can deduct on lease payments. Disadvantages is that you don't own the asset, right?
Okay, so Professor,
Go ahead, Lakeisha.
let me ask you a question.
Yep, go for
So
it.
is leasing better than versus than buying like they're owning something? Because to me, I even though it takes a long time to like pretty much own something,
Sure.
but I want to leave, I want to have something, I want to leave something to my children. So that's why I'm like, it should, is buying a house, worth it, buying a car worth it. Should I be leasing a house? Should I be leasing a car? You know what I'm saying? But if that means it would never be mine, that means I never will own it.
Right. So there's cost factors that you need to consider when you lease versus when you buy. Typically, when you rent an apartment versus buying a condo, the advantage to renting is that you don't have to worry about maintenance. You don't have to worry about HOA. You don't have to worry about maintenance. You don't have to worry about whatever, right? That's the landlord's responsibility. But it costs you more to rent it.
It does.
Because
It's
it's higher than the cost of a monthly mortgage.
Professor, I'm in that situation now. Like the more income I make, the higher they're going to keep going up on me.
That's right.
And it's like, I'm like, now, okay, now I'm ready to go and buy my own house.
Yep.
Because see, at that point, they're only just going by how much I make. They don't care how much of my income keep going
But
up. They're
right,
not going to change the price of my payment on my house. You see what I'm saying?
I do.
And that's what the problem that I'm in right now. And it's like, how can I have something or own something if y'all going to keep constantly coming after my money?
Right. So what you need to do in that decision is you need to look at the cost of ownership versus the expense of a lease.
Okay. Okay.
And the cost of ownership is not just the mortgage.
Okay.
It's also operating the house.
Okay.
What do I
Okay.
mean by that? How much on average utilities are? How much on average your insurance expense is going to be? How
Okay.
much on average you're going to need for repairs?
Okay.
All of those need to be factored into when you purchase a house. We call
Okay.
it the cost of operating the house.
Cost of operating the house. Okay. I'm going to remember, write that down. Cost of operating the house.
So what you want to do is average those things out, add them
Okay.
all up together, and if it's less than the monthly rent, then it's no brainer. Then of
Okay.
course, yeah, you buy it.
Okay. 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 I'm so glad you got on this subject because I definitely definitely wanted to
Sure.
know. But I'm tired of just giving away my money. Like I don't want to just give away my money because you
I
see
hear
I'm
you.
making money. You see what I'm saying?
I
Like you got
do. Yeah.
to open up on me.
And the same concept applies with leasing a car. So with cars are very expensive to begin with. Okay, the cost of leasing a car is more than the cost of owning it. Why? So with a lease, just like we talked about with a house, the cost of maintenance is built in. Okay, if you take out a loan for a car, if you run the time value of money concepts that we just talked about, you'll end up paying more for the lease than you will to own the car. Uh, that's just how it works, right? So run out like the monthly lease payments times the number of years of the lease. That'll end up being the total cost that you would have paid over the life of a car loan.
Yeah, but see, it's investor. That's why I never wanted to lease a car.
Yeah.
Because I remember back in the day, this guy used to lease a car. I used to wonder, like, why he spend all that money leasing the car instead of buying the car? Like,
Yep.
I would, and so that, and I'm being honest, seeing that, man, I'm like, I'm not just giving away my money. Like, I'll rather
Exactly.
buy my car. I don't care. I'd rather pay a monthly note because I know at the end of the day, it's going to be my car.
That's right. That's right. Yep. So in most cases, I would say owning a car is much better. There are some cases where I would say, yeah, leasing might be the better decision. In those cases, it's like I don't drive very much. I want to be maintenance free. There's life circumstances where it makes sense to lease than it does for owning. For example, I'm trying to convince my mom right now to sell her house and move into a rental. Why? Because she's getting a lot older. It's more difficult to take care of the house. It's becoming more of a burden than a blessing. So when that life instance happens to you, then you might change your mind. So just things to consider, in the lease versus buy decision. And that leads me to my next topic,
Thank you
uncertainty.
for that, Professor. Thank you.
Absolutely. Yep. We call those the qualitative factors of decision making. Leads me to my next one is uncertainty. All capital investments rely on factors that are uncertain. For example, estimates of revenue, expenses, and cash flows can be uncertain at times. Like we didn't expect to go into a pandemic this year, but we did, and so that drove revenues down, expenses up. So that's part of uncertainty. So these are things to consider as well. Changes in prices. Prices change regularly based off of changes in the economy. We know that. Prices go up or go down based on things like inflation or deflation. Prices go up and down based off of demand changes, based off of consumer behavior changes, things like that. That changes price levels. Also changes in the exchange rates basic against the US dollar. Those types of changes will change price levels. Other qualitative considerations to take into account, especially in manufacturing, which we've been talking about this entire course, they include things like product quality, manufacturing flexibility, employee morale, manufacturing productivity, and market opportunities. Capital rationing. Capital rationing is where we allocate funds among competing investment proposals. If I have more than one proposal in front of me, I might decide to go with more than one proposal. That's when we'll implement capital rationing. I'll say, I'm going to allocate this amount of money to this project, this amount of money to this project. Okay? And that will aid the decision process. And that reaches us to the end of chapter 25. Any questions on chapter 25 before we move to chapter 26? We're good? Okay, sounds good. I'm going to stop the recording here and I'll pick it up in chapter 26.